Welcome back to another episode of Palisade Radio. I'm your host, Vermeulen. And on today's show, we welcome Chris Vermeulen, who is the founder of thetechnicaltraders.com. Welcome to the show, Chris.
Hey, thanks for having me, Karim.
Let's begin by talking about your early career and how you ended up speculating in the markets, Chris. Have you always been interested in the markets from an early age? And you also have an interesting story about catching the final wave of the dot-com boom and what happened afterwards. Can you talk to us about that as well?
Sure. Yeah. Well, I did get interested in the stock market at a pretty young age. I got caught up in it in high school when I was 16, taking business class. There was like a stock competition against other classrooms, and if you can pick the best portfolio, then you won something for it. I didn't win this, but it got me hooked. Seeing these people with $100,000 fake portfolio turning into several $100,000 in a semester, I was like, okay, this has got my attention. So that was when it really kind of grabbed me, and always held somewhat of a focus there. And it wasn't really until later that summer I saw a package in the mail from Larry Williams on trading futures. And of course, I didn't even know what futures were, but it said trading on the cover. So I dug in, and his sales marketing package really got me hooked onto trading, and I wanted to open a futures account and start trading. And I was only 16, so my dad's like, well, when you're old enough, you can, but we're not trading futures. And so as soon as I turned 18 in college, I was able to open up an account here in Canada, and I started trading. And that really kind of was around the 2000 kind of bubble. And my first trade that I bought was a company called Palm. Remember Palm Pilot? They were like the first handheld smartphone type thing. I thought it was the coolest thing. And I bought shares of that. And then I went away for 3 weeks for Christmas holiday. And I came back, and my $2,000 trade was worth about $8,000. And I was in college. So I cashed out. And then I was hooked forever. So that was kind of my whole start to trading. I got hooked into it, and first trade was a huge winner, and I ended up using all that money. I started to move into some trading courses and started to take seminars and things like that, and eventually I lost almost all the money that I had made, simply because the bubble burst and buying things didn't work anymore. And that was my real wake-up call when I more or less blew up my first trading account. And so that was kind of, I caught literally the last pop in the tech bubble, and then all my trades after that lost money, and I blew my account up. So that was kind of a quick start and a quick finish, but a sobering experience, and really kind of set the tone that focus needs to be done for the rest of my trading.
Okay, well, let's talk about the journey into technical analysis. Did you start out reading the markets only using technical analysis, or was it a continuous process of trying different methodologies throughout your career? All successful investors make money in different ways, but it's because they use the method that usually suits their personality rather than simply copying someone else that tends to work best. Would you agree with that?
Yeah, I totally agree. I think you do need to trade with what meets your personality and your mindset. I mean, every brain processes, the exact same chart. We're all looking at it. We all process it in a different way. And the way I'm kind of like a quasi-engineer. I like to build things, invent things. I'm a pilot, so I like checklists. I like systems in place. So technical analysis, when I read my first book on technical analysis and reading chart patterns and why things happen, I was 100% set. Okay, I'm going to focus on the charts because price is the only thing that matters. As long as I follow price, then I think that's the best thing going forward. And I've learned over the years, looking at fundamentals and all that, and trying to trade news, to me, it goes all out the window. It means it has zero input and into my trading. And I'm 100% technical analysis. And the truth is, you don't make money unless price moves in your favor. Who cares what the news is? Who cares what the earnings are? Who cares what the rumors are? Because they're all a complete, really 100% guess, and they're very random. So there's no point in trying to trade any of that stuff. Just follow the price using trend analysis and risk tolerances and the strategy that can lock in trends and you're set. So I just follow price because it's the absolute only thing that is going to grow our account. Price needs to move in our favor, not focusing on the fundamentals.
Your analysis of gold and silver over the last year or so has been very accurate so far. At the beginning of the year, you're predicting far higher prices, and those targets have been met. So from a big picture perspective, Chris, is this the beginning of a multi-year bull run for the precious metals? And for maximum leverage, are you going to be speculating on the juniors within this space? How are you going to play it?
Yeah, well, I'm a big believer of the Stan Weinstein stage analysis. And if you know anything about that, what it is he breaks the markets into 4 trends. You've got stage 1 accumulation, stage 2 markup, stage 3 distribution, which is a topping phase, and then stage 4 decline, which is a bear market. And precious metals has been trading sideways in a stage 1 basing formation for many years. Just in the last month and a half, it has entered into a stage 2, the markup phase, which is the bull market phase. So yes, metals are in a new bull market, and there should be lots of upside potential going forward. And I think miners are a great way to trade them. I do feel as though we need to be aware that when a bear market hits in the stock market, when it goes into a full-fledged bear market, there will be liquidation, there will be margin calls, and the market will pull down most likely metals in miners to some extent. We saw it happen in all of the previous more or less bear markets in equities. So I think we're going to see metals and miners continue to outperform and do really well. Looking forward a few more months. When the stock market gets into a bear market, I think they could see a little bit of weakness. They could sell off. They could have a somewhat of a dramatic a pullback, but I think they'll still hold up well within their bull market. And once the bear market in equities starts to end, say a year from now or a year and a half from now, whenever that is, we'll see the miners, they'll bottom before that, and metals, and we'll see them take off to a huge rally. I think it'll be very similar to 2008 if you were to review metals prices in the market. But this time around, I do feel like they'll hold up a lot better than they did. I don't think they'll sell off as much. I think there's more chaos and more people are aware that there's more bigger global issues, more financial issues in all kinds of different countries, that it's going to keep gold afloat, and that's going to help keep the miners up as well. So I think we might see metals pull back or flatline during the first portion of the middle portion of the bear market in equities, but then they're going to just take off. And I think all of that price action is very bullish for long-term growth. And we could see metal, gold and silver trading dramatically higher a year or two from now.
Let's specifically talk about the mental game of speculation and trading and how important this is when you're trying to become better at it. Keeping control of your emotions and letting the charts tell you what you need to know rather than making the chart fit your opinion is probably the hardest thing to learn. So how did you get better at this, Chris? Or is it simply a case of going through a number of cycles and learning from your mistakes as you went along?
Well, there's no doubt experience is worth its weight in gold. You learn a lot going through them, and I think I blew 3 trading accounts up before I kind of hit rock bottom and saying, okay, I got to stop trying to go for these huge wins. I need to have stops in place, and I need to get out when my stop is triggered, not just hold on to it and watch things fall. So really there's kind of 3 core things that I think will make trading, investing work for somebody, which is you've got to have the proper position size. So many people are putting on a position size they think is good, proper, but it's usually 2 or 3 times bigger than it should be for their true risk tolerance and to keep their risk reward in line with their overall portfolio. And position sizing is something I always stress. Every position, I base it on how much potential risk there is to get into this trade, the upside potential, the downside, and then I'll make that position size accordingly because I don't want to lose any more than more or less 1 or 2% of my entire trading account on one trade. If it was a complete flop and we lost, say, 80 or 90% on it on some ridiculous trade, which actually happened with a VIX trade we put on last year. We lost 98% in 2 days on a VIX trade, getting into a VIX ETF that imploded, but we knew it was going to move 50% give or take in the next 24 hours. And unfortunately, it imploded. It wasn't so much the issue. We were actually, timing was right. It's just it imploded overnight. But all it did was it was about a 0.5% loss on our trade because we took a very small position size. It was a high risk, high reward, tiny little gamble style play that if the financial system wasn't built on a bunch of crumbled bricks, these things wouldn't just crumble and erode overnight. We would have nailed it. But my whole point is you've got to have proper position sizing. The next thing is you've got to have a trading strategy, you've got to have a system in place that says, okay, this is when I know we're starting a new uptrend. This is when I get in. This is where my stop needs to be. Here's my first target. This is what I'm going to do when I hit my first target. I'm going to move my stop up. Here's my second target. Here's my runner to catch this trend if it continues on for extended periods of time, months and months. And you've got to have a system in place, and you've got to follow it, because as soon as you fall off following your system and start going emotionally, you're going to get out early, you're going to miss trades, you're going to overbet. So you got to have a trading strategy. And then on top of it, you've got to have the strategy and trade the asset class, whether it's stocks, futures, ETFs, or options, whatever it is. You've got to have the trading strategy that fits your personality. So I'm not somebody who wants to sit at the computer in day trade and try and pull, a few $100 or $1,000 out of the market every day. I don't want to work like that. To me is work. I want to follow the markets. I've created algorithms that read the market and give me the trends and tell me when something's overbought, oversold, when to trim profits, when to re-add some more. And I sit back and I'm looking for 2 to 3, maybe 4 trades a month. That is it. And I prefer the index, the SP 500 for trading, because you can move large amounts of money in and out with ease. And you've got multiple leverage. You can use a 1 times to 3 times ETF. And I like trading the precious metals and some of the ETFs for, gold miners and oil and natural gas. So I'm only looking to do a few trades a month. I'm almost always in cash. At least 50% of the time I'm in cash, and probably 90% of the time I'm in 75% cash. I focus on staying out of the market, and I only get in when there is a new trend starting. I catch the run, and then I get out, and I look for a fresh setup with lots of power. You won't find me holding trades through like the August type of price action, huge volatility up and down for an entire month. You won't catch me holding big positions or any positions during that, because it's range bound. It's unpredictable. We need a breakout to the upside or to the downside before we get into a position. And it broke to the upside. We ended up getting long, and we're pushing up to new highs. So we're just looking for these trends. So the key is to trade that fits your personality. If you don't want to trade all the time and it feels like work, it's not the right trading strategy for you. You got to find a system that catches those trends or those moves that you believe in, that are in your comfort zone, and you focus on those.
Let's briefly go over some of the indicators you look for when identifying market tops and bottoms. You shorted the markets during the 2008 crash and were very successful at this. So what signs told you the crash was coming and that there was going to be a major decline rather than a brief downward move?
Yeah, the indicators, I don't get too fancy with indicators because I follow price, and I'm using Stan Weinstein's model. So tops are really tough to pick. So many people try picking a top, and they're shorting the market, and they always think it's the top, but tops are really hard. The market has a natural tendency to grind its way higher, and it'll make you broke if you're trying to pick tops. They're the most deadly. That's like the most deadly trade to try and do. Picking bottoms, on the other hand, in a bull market is fairly straightforward. There's standout lows. You might not get it to the first day or 2 or 3, but they're very, very clear in terms of identifying a panic washout low and a time that the market should bottom. So when I'm looking for market tops, I'm really just looking at the overall chart pattern, usually on the daily chart. I like to see what the volume is doing, and I follow moving averages, which are very, very basic, but it tells you where the average price is going. A short-term moving average gives you the short-term price action, and if it's starting to break through longer terms, longer term moving averages and increased volume, it's a sign that, the momentum is shifting. And you got to look for support levels being broken. And sometimes for upside targets or for tops, I'll use Fibonacci extension, which works exceptionally well for swing trading. You're looking for a trade that lasts maybe a month or so. Fibonacci extensions allow you to take the previous rally and pull back, and you can map forward that momentum. If it carries on, we'll bring the price up to this next target. And I use that always for my first target and my second target. There's different extensions that I use, and those are great for short-term turning points. Now, trying to pick a bull market top is pointless because it takes months, sometimes years for a topping formation to form. And you're best just to let the market rotate and start to collapse. And that's when when previous support levels are broken and there's panic selling in the market, that's when you can start to focus on getting out of equities, focusing on safe havens, and moving to cash. So that's kind of the whole topping formation. It's very difficult to do. Picking bottoms, on the other hand, is a little easier. I've got a few indicators that I use. I like to watch. You can program it into pretty much any charting platform, but I look at the NYSE up volume and down volume, and I divide them. You divide up volume by down volume, and then I have another indicator, which is down volume divided by up volume. One of them tells you when you've got panic selling, when there's more shares being sold than there are being bought in terms of hitting the bid or ask. And the other one tells you when everyone is buying and there's greed in the market. And so I use them as a contrarian indicator. When there's panic selling and everybody's unloading, the price is sold off into a support zone. The price pattern is showing exhaustion, volume showing it. You've got the volatility index spiking. All these things come together, and suddenly you're like, okay, everyone is panicking out of the market. And when everyone is running in the same direction, you usually want to start thinking about going the other way. And that's when I'm looking for some type of entry to get into these panic spike sell-offs in the equities market.
Fantastic. Okay, as we begin to wrap up, Chris, is there anything else you'd wish to share with our listeners today? Anything else in your mind?
If you really want to fast track trading, in my opinion, you scrap all external news, stop reading all kinds of different newsletters, because I see it all the time with traders. They read 5 different people's articles or opinions every morning, and then we get into a position and they're like, well, this guy said this is going to drop to here, or it's going to do this. And it's so easy to get confused. And the problem is you just get over too much analysis, and then one cancels the other one, and then you're stuck with this, it feels like a 50-50 coin toss. You really do need to pick a strategy that you believe in, that you've seen work, that's proven, that works with your personality and has risk tolerances in place so that you're never going to blow up your account on any given trade. You could have 10 losing trades in a row and be down maybe 10% on your entire account. Most traders and advisories don't do that. They just give you trades. They don't tell you how much to do. And when you take a hit, you can blow up a huge portion of your trading account. And all the things I'm talking about today are what I kind of cover. I do every day. I follow the markets. I do a video on what happened yesterday, what's happening today in pre-market, what we're looking forward in this trading session. I recap on all the major markets, what to expect. And whenever I have a trade, I share it with my followers, and we all trade together, and I update them with the charts as the trades unfold. And so, I mean, if you're looking for a kind of a mentor, someone to kind of follow that, has your best interest at heart, because the trades are based on what I do and manage for my account. You can follow me at my website and get that type of research.
Thank you very much for your time today, Chris. It's been a pleasure having you on the show.
Hey, thanks, Krim. Always a pleasure.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be? It actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?